stocks and markets.
Gold, gold, gold.
Yes, well, that is the big news that we want to talk about today. We'll cover off what's happening in reporting season in the next episode. But precious metals, gold and silver, they've kind of been bubbling away a bit under the surface, perhaps not getting the attention that they deserve.
Yeah.
But as we said, like the headline is gold has hit a record high. $25,000 an ounce.
2,500.
$2,500 an ounce. Good correction. First time in history it's hit that price.
Yeah, I was surprised. Well, when you said bubbling away, I think that's that's how I feel about it. I've been so caught up in what's been going on in the stock market that I haven't kept my eye on gold. But yeah, up 25% in the last 6 months, up 31% in the past 12 months.
Yeah. Now, to put that in context, Australia's ASX 200 is up 4% in the last 6 months and 12% in the last 12 months.
Yeah.
America, the S&P 500, up 12% in the last 6 months, up 27% in the last 12 months. Still not beating gold.
Yes.
America's NASDAQ up 11% in the past 6 months. It did have that sell-off, as we all remember, up 32% in the past 12 months. So the tech-heavy NASDAQ 100 has just outperformed gold.
The Mag 7 should include gold.
Well, I mean, the question, and what we'll talk about is this short-term? Is it going to sort of revert to a longer-term trend and maybe fall a bit, or is this a sign of things to come? So we'll cover off on that. But before we do, the additional context, the additional news, it's not just gold. Silver is also running, up 26% in the past 6 months, and extend the timeline, it hasn't done as well, up 25% in the past 12 months. So silver's made its move recently.
Now, we should also put in context not only against the equity market returns, Ren, but its own average returns. Gold has averaged over the past 50 years a return of 6 to 8% in USD. So slightly below equity market returns, but it just really puts into context how ridiculous the price movement has been over the past 12 months.
Yeah. Now, gold is seen as the classic hedge against inflation.
Yeah.
So it's seen as something that will hold value as your dollars or your currency gets inflated away. But if you look at that 50-year return profile, 6 to 8%, inflation has not averaged 6 to 8%. It's probably averaged half of that, call it 3 to 4%. You can see that gold has outperformed inflation over the last 50 years.
Yeah. I read somewhere else that another analyst, his way of thinking about it is, on average, gold is generally 2 to 3% above inflation historically. Okay. That's the way that he looked at it.
Now, there are certainly people listening or watching to this saying inflation is undermeasured and the value of our dollar is actually degrading at 6 to 8% or even more a year. Yeah. Separate discussion for another day.
That's for the Equity Mates Goes Deep YouTube channel.
Okay.
That we haven't started. Anyway, Ren, the point of this segment is A, to recognize what's going on if you haven't kept up with gold and silver, but also B, to talk about why this is happening, because it is unusual looking at its historical returns. So there are a number of things. You spoke about A, it's seen as a reliable store of value. Yeah. And given what's going on at the moment, geopolitical unrest, interest rate uncertainty, inflation, gold, people turn to gold for safety. Yeah. And that's what's happening here. But also because we're now starting to see a change in the interest rate outlook. The US is starting to say that they're definitely going to be cutting rates. What happens there is that there's starting to be a weakening in the US dollar, which we've spoken about on the show. And then traditionally, this is where gold tends to perform well.
So can I just pause there? Because those two things, the first is in an inflationary environment where rates are rising, gold performs well because it's a hedge against inflation. Yeah. And now you're saying in a disinflationary environment where the interest rates are being cut and the US dollar is weakening, gold also performs well. Yeah. That's what you say?
I guess so.
Okay.
Yeah. Sorry. Well, I think the first is traditionally, if that makes sense, but what we're seeing now is the drivers now is that the weakening of the US dollar is is what's sending people to buying gold.
Yeah,
There is another.
I think the actual through line between both of those is in a high inflationary environment or an environment where the US dollar is weakening. The commonality there is the US dollar is weakening.
Yeah.
And so gold is priced in US dollars, and so gold does better in environments where the dollar is weakening.
Yeah.
Whether it's for whatever reason is driving it.
Yeah.
Yeah.
The other factor is central banks. So back in 2022, the central bank gold buying binge kicked off.
Okay.
So
not just the US central bank.
Globally, and really led by China.
Yeah.
They started buying huge amounts of gold for their reserves. That started in 2022. The most recent quarter that we have had was the fourth largest quarter since 2022 of reserve banks buying gold. But yeah, it was the fourth largest quarter. So over the last 2 years, the reserve banks have been going nuts. And of course, this is putting pressure on the gold price.
If people want to go deeper on the whole central banks moving away from the US dollar, the episode to listen to in our back catalogue is the one with Chris Judd, because that certainly forms part of his investment thesis and sort of where he sees potentially the world going. I would say that the idea that the world is going to move away from the US dollar and the current iteration of it is the BRICS countries starting to do their own trade in non-US dollar currencies. And the BRICS is Brazil, Russia, India, China, South Africa is the S, I'm pretty sure. There's always variations of this. The classic example that I always go back to is Warren Buffett's dad only invested in gold because he was convinced that the US dollar was being inflated away and was worthless. And so all he did was invest in gold. And I'm sure he got all right returns from gold, but he could have done better if he was in equities.
Yes.
I think it's important to have a historical perspective on the idea that the US dollar is a few years away from dying.
Yeah.
Because it's been a few years away from dying for a century.
Yes. Yeah, exactly. It's always ongoing.
But that isn't to say that like gold doesn't have a role in the portfolio, and some of these geopolitical trends are real.
Yeah, absolutely.
It's just the speed at which they will play out.
Yeah.
Let's get back onto that. You can listen to the Chris Judd episode.
Yes.
As retail investors, it's important to know it's not just central banks buying gold. It's regular punters buying a lot of gold as
Absolutely. And I read that Costco sell gold bullion.
Yeah.
They are generating an estimated $100 to $200 million per month in gold bar sales because of the frenzy in the gold price. And they typically sell these gold bars for about 2% above the spot price.
I don't think it's just the frenzy in the price, because if you've ever been to America and listened to their conservative radio, the amount of people selling gold is wild.
Really?
Yeah.
Are they all those the guys who dig bunkers in the ground?
Yeah.
It's doomsday preppers.
Yeah. There's a lot of it's on, like Rush Limbaugh and like a lot of those right wing shows. It's like, doomsday preppers, weapons, and buy gold. Yeah. Fox News over there would have a fair bit of gold ads as well. It's a real thing.
Crazy.
But yeah, Costco killing it.
Wow. Well, anyway, we should probably close out with, if you're interested, how can you invest in gold here in Australia? And the recommended way, at least, is finding ETFs that are backed by gold and actually follow the spot price. They're not underlying derivatives.
Yeah. So to spell that out, there's gold ETFs will come in sort of two forms if you look under the hood. The first is a gold bullion ETF, where if you buy the ETF, they go and buy physical gold and they put it in a safe, and the ETF units correspond to real physical gold that is held, I guess, on your behalf as the ETF unit owner. The other one is a synthetic ETF that tries to track the price of gold using derivatives and other options. And what we're saying, and what experts around the world will tell you, is that buy the bullion ETF over the synthetic ETF. It will more closely track the price. There's less counterparty risk rather than dealing with options and stuff like that. And there's no reason at this point not to buy the bullion one. Like the fees are similar, and it's just a better constructed product.
Yes.
So that's obviously generally speaking, but it's pretty emphatic general advice when you're looking at gold ETFs. The third kind of ETF you'll see are gold miner ETFs. Just be careful. You're not technically tracking the price of gold. It's like a leveraged bet on the price of gold with company risk built in.
Yeah. So 3 examples here in Australia. You've got the Global X Gold, which is the biggest gold ETF. The ticker is gold. Then there's the BetaShares Gold Bullion, ticker is QAU, and the VanEck Gold Bullion ETF, the ticker is NUG, NUGG. Now, not advice because there is no guarantee that this is going to continue, but if you are interested in having gold exposure, there are some examples.
Nice.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.